Okay, IAS21. I am looking at it from the point of view of a single entity here. I might do a bit of scribbling here when I talk about groups. I might do. But let's quickly highlight the key point here. We need to discuss changes in Forex because, well, because there's issues to do with. I mean, there's a criticism of all of this anyway because we're using these rules of average rate and opening rate and closing rate, and these are averages anyway, so there are issues here. But but in terms of determining, in terms of how we represent the accounts in what currency, we're typically looking at a number of things. Where in order to determine this, we need to look at the currency that fundamentally influences the sales. So this is from an individual point of view. Sales price, currency of the country where strong competitive forces are, and the currency influencing labor, materials, and those. So that's where we're really going pretty much as to what currency to deal with here. Jumping to the key issues here, non-current assets. We just don't do any retranslations. We just keep them as they are once we've bought them. These are so typically your non-current assets, PPEs, that sort of thing. But your year-end balances, we do monetary balances, payables, loans, trade receivables, closing rate, we adjust every single time and straight away recognize everything to the P&L, operating expenses. That's the key thing. So initially, of course, things will happen at the spot rate. If there's payment during the year, that's wonderful. We take the spot rate and we pay and move any exchange rates into the P&L as well. But if at the end of the year we still have any outstanding trade payables or trade receivables, then we just adjust, like I said anyway, using the closing rate and put that through the income statement. For groups, I'm just going to highlight it very quickly here. Forex for groups, there are three things to consider. It's important to consider, if you like, the opening and closing entries of the assets that we're bringing into our accounts. So like working two, so think working two, and just think of those assets. So you have your the value of the subsidiary at the time you're bringing it in, or let's say you've been running it year on year, whatever. Those assets, you'll be given a kind of opening rate, so the net assets, and there'll be a closing rate. And in effect, we need to find what the difference is. So whatever, if you have a 1 million here, it's just a $2 or whatever, £2, and then you have 1 million here, and it changes to £2.50. Basically, we need to calculate this, and then, well, this probably would have increased 1.5 over the year because you would add profits in. So your profits would be at the average rate, and then your opening balances would be at the opening rate, and your closing balances would be at the closing rate, if you like. So I'm expecting opening so 0.5, so that's 1 plus 0.5 to give 1.5, but of course I'm going to be looking at this 0.5 at the average rate, and hence you will have a forex difference. The second thing is goodwill. So you need to look at goodwill at the opening rate. You make sure you'll have goodwill at the close. You'll have impairment, which will be at the average rate, and then you'll have goodwill at the closing rate. So this minus this will give this. So, but you'll have this minus this will not give this, because, and there'll be a difference, and that's your impairment. And of course, it's important to think about, to look at working two, to look at the average, to look at the profit. So whatever your profits are, do what you're doing. Treat the business as normal. Get to the end of the year, whatever your profits are, your post-acquisition profits, as you would expect in working two, and then deal with at the average rate, and that's what you now split up between the parent and the non-controlling interest. And that fundamentally is your forex for you, IAS21. But this is in the individuals, but then there's forex within, of course, the groups.